Well, good evening, everyone. I am glad you guys could join us. We've got a pretty good group tonight for both Dennis Chen and Mark Sebastian, who are the co-authors of the Option Traders Hedge Fund, which is not quite ready for release. I think, what, June 3rd?
June 3rd is the official date. Yeah, whatever that Tuesday is. First Tuesday in June.
So June 3rd.
That is June 3rd.
So June 3rd, you can go ahead and order the book, and it should be available, or I'm sure it'll be there on the
or
local.
Maybe June 5th, I guess. Yeah.
No, it's June 3rd. It's the first Monday.
Oh, well, that's the 4th then.
Is it the 4th?
Yeah.
Well, it says the 3rd on Amazon.
Well, then it's the Sunday. Then it must be the Sunday.
Yeah.
There you go, folks.
Yeah.
Now you know.
So it's out on Sunday.
Mm-hmm.
All right.
So you can wait by your door for the Amazon man to deliver your book.
Yeah.
Because technically we're supposed to be receiving it on the 24th of May to get out to the booksellers.
Oh, is that right?
Yeah, and then they deliver it. So if you order it, you should be getting it on the 4th.
Which will be awesome. Yeah, it'll show up at your door. You know, if you're anything like when my wife read the copy, she goes, "This is the fastest I've gone through a book since I read Hunger Games." That's how much she likes the book. So, and she doesn't even like options. That's the thing. That's the crazy thing.
You know, I don't think I could get my wife to read an options book, even if I wrote it.
Yeah, no, yeah, no. My wife, she's got her stack of, her 3-part set of Hunger Games. She has the Option Traders Hedge Fund, and then a stack of Us Weeklies and In Touch magazines. And you know, that's the order that she reads. So she reads a little out of Hunger Games, then she'll read, like, for hours at a time, the Option Traders Hedge Fund.
Right.
There's a question in the chat. Is the book going to be available in Kindle? Yes,
it will be.
It's supposed to come out the same day that the paper version comes out.
Yeah, you know, one of the things, though, this actually got brought up to me from I was sitting down with one of my new business partners in the trading firm that I'm starting, and he was like, "Why would anyone want a Kindle copy with a book like this? I would want to write notes in. I'd want to be kind of highlighting the things that I'm be pointing at." So, and I hadn't thought about that, but he brings up a lot of good points. You know, my Natenberg book is beyond marked up with kind of my thoughts, my questions, different things I needed to ask people about. And so if I could steer people toward this being a hardcover, as it's as much a textbook, well, it's not a textbook, but it's as much a guidebook as it is anything else. But we'll talk about that. So.
Well,
anyway, I totally derailed this thing with my Hunger Games thing.
Yep.
Now imagine being Dennis trying to write a book with me.
Well, the one thing I'll tell you is that I already pre-ordered mine, and Amazon right now is you know, if you pre-order, you get a discount. And I'm assuming that when the pre-order period's over, it's, you know, the discount goes away, but who knows?
I would think so. And actually, the more that it gets pre-ordered, the more they discount it.
Oh,
and everybody gets the final discount price. So you know, everybody go out there and buy your Option Traders Journal.
No, hedge fund.
All right. Well, let's get down to the business at hand, and that's kind of sharing a little bit about what the book's about, and kind of giving everyone a flavor of how you guys think an option trader, a retail option trader, can manage a portfolio like a hedge fund. So with that, you guys, I don't know which one of you is going to start, but
I'll start.
Grab control.
Sure thing, boss.
Because nobody wants to look at my slide anymore. Oh.
All right, this is the cover of our book. This is the Option Traders Hedge Fund, a business framework for trading equity and index options. So this is going to be the order of things we discuss. We're going to talk about myself and Dennis. We're going to talk about the process of becoming a successful option trader. A little overview of the book. I'm going to pull out a couple of small highlights of things that we cover in the book that maybe you haven't heard before, and then we'll take plenty of time to Q&A, and hopefully once the book gets released, Chris will have us back on, and we can you guys can, having read the book, sit down and ask us anything you want to know about what's going on. So with that, let's move on to about the authors. Now, my name is Dennis Chen. I am the founder and no, I'm just kidding. Dennis, one of the cool things about knowing Dennis, I was actually there at the very beginning of Smart Income Partners. When I left my old business, Dennis actually was my first, what we call professional client. He was a, moved the wrong way. He was my first professional client, my first client that was using me more as a consultant. And one of the cool things Dennis and I did together was essentially help him hash out what programs he should use, what clearing firm he should go through. All the kind of really fun stuff. But, it's great. Dennis is, every time I work with him, I'm impressed by how smart he is. And you can see why. He's, his old boss, Mitt, is doing pretty well.
Yep.
So do you know him?
Not personally. He was in the Boston office when I was in the Dallas office.
Gotcha.
He was buddies with my direct boss at the time.
Okay. You got the MBA, as a master's in computer science. You've done a lot of different projects. Option trading and starting Smart Income Partners has just been the latest of your string of successful ventures. It's one of the great things about Dennis is when he asked me to do this, I knew it was going to be a success because everything Dennis touches turns to gold. So at least that's my opinion.
You're very kind.
Well, thank you. And obviously, my name is Mark Sebastian. I've been here several times, but by now you don't know who I am. I am the Chief Operating Officer of OptionPit.com. I'm a former CBOE and Amex trader. This is not on my bio yet, but I am now a partner of Sumo Capital Management, and I'm going to be, which is a new proprietary and market-making firm that I'm going to be a owner in the holding company of. I'm an all-star writer for TheStreet.com. I'm on CNBC, Bloomberg, and Fox all the time. I think last week I was on TV 5 times, once each day, and it actually does get a little old. And I'm published all the time, and my little baby in the writing realm, my really first stab was Expiring Monthly, the Option Traders Journal, which is a monthly magazine. Dennis, you've written for us before, right?
Yes, I have.
Yeah, it's a monthly magazine we put out that is for option traders by option traders. So, one of the fun things I think you're going to find out about this book is that between Dennis and I, there are a lot of contracts traded on a daily basis. Dennis is actively managing a hedge fund, and I still trade my own account pretty actively, and even more so now that I am basically running a trading firm. Excuse me, an owner in a trading firm. There's a Chinese wall between Option Pit itself and Sumo, so I am an owner of the holding company, but not an active partner, if that makes sense.
So you're not actively trading on Sumo?
I am going to be, actually it's interesting, I'm going to be allowed to actively trade under Sumo, but I'm not going to be allowed to actively run Sumo. Does that make sense?
No, but I guess it's due to regulations, right?
It's regulations.
So
exactly. It's all regulatory.
Yeah.
I'm allowed to
Yeah.
trade my own account as much as I want and work with people. I just I can't run a trading firm and work with people and educate people in the same way. So as long as I'm just kind of managing my own money is basically what it comes down to. So with that, let's move on to becoming a successful option trader, and I'll pass it off to D.A. Chen.
Great. Okay. Not sure what screen you're seeing. Are you seeing the agenda screen? Okay. Because I have multiple screens. Okay. Well, I just wanted to give you a little bit of context of the book. Where does the book fit in? And I wanted to take a step back and talk a little bit about how do you become a successful option trader? What are the stages of becoming a successful trader? So basically there are a couple of stages that one goes through in order to become, I don't know, for lack of a better term, a master of the trade. So let's review each stage. The first stage is desire. I mean, I remember when I was in corporate America and I was working for someone else, I always wanted to trade for a living. So basically everybody at some point in your life on your path to become an option trader, you decide that I really want to do this, right? So you begin, some people begin immediately trying to trade options, or you might go to the next stage where you acknowledge that you don't know. You're aware that you have no clue what you're doing, and you have to admit that you don't know before you go to stage 3, which is
and may I make a comment?
Yes.
How important awareness is. You'd be shocked how many people will get lucky over a period of time and assume that they know everything or that they're great option traders, when really they're just kind of hitting they're hitting a easy period of trade. I think we saw that happen to a lot of people in like 06.
That's correct.
And again in 09. But I used to laugh about this, but it's not what you know or what you know you don't know. It's what you don't know you don't know. And that's why forcing yourself to learn is so important. So we'll move on.
Yeah, correct. I mean, it's like, if you don't know what you don't know, you'll get blindsided at some point. So people start exploring. You search for knowledge. You start reading investment books, going to seminars, joining investment clubs, buying newsletters, and so forth. And at some point, you get the courage to start trading. So, whoops, I got stuck here. There you go. The next stage is imitation. You start following other people's strategies or following strategies that you learned in the exploration phase. And you start trading them with limited success until a big change in the environment comes and you find out that you still don't know enough and you get back to awareness. So you still don't know after some limited success, and you continue the cycle. And the cycle repeats itself until it comes to a point where you experience enlightenment. There's that aha moment that you say, oh, now everything start to make sense, right? After experiencing all the different strategies, all the different ways of doing things, you get it. And you create a framework, you define a system that works for you. Everybody has a system. Everybody has a mental model, but they're different for everyone, right? And once you get to that point, then things start clicking, you start making money, and you might be a master, right? But this is the thing. Mastery is elusive. To be a true master, you become humble. You're good at making money. You might be considered an expert, but you shouldn't be complacent because the market always changes, right? You should never think you know it all because it's constantly changing, right? So you should use a framework and keep updating it. Keep updating those mental models as you go on as a trader.
Right, like Dennis, you were pretty successful in your first couple of years of business. Do you trade exactly the same way that you when you started?
No, not at all.
No, neither do I. 4 years ago, I traded a lot of SPX and I traded a lot of Dow. Now, almost exclusively, I'm trading volatility products. I trade a lot of Apple and a few other things, and my strategies change. I can't stress enough how the idea that you can learn a system and it'll be somewhat foolproof and you can make money off it for years and years and years is the silliest thing. Even those that claim to have a system where, oh, I sell an iron condor every month, they're quietly tweaking it all of the time. It's unbelievable the way those tweaks happen. And so you can't just, complacency is basically the end of your trading. You will blow.
That's correct.
You'll blow.
But the key is to have a framework that you continue to tweak as you go on as a trader. I mean, that's where, well, let me skip this slide. This is the summer slide. That's where our book comes in. Our book provides you, it fits right between the segments of imitation, enlightenment, and mastery. We provide you, or we suggest to you, a framework that we use for running the hedge fund. I mean, we use this framework that we call the one-man insurance company, which is we manage the hedge fund exactly as an insurance company, as a Geico or an Allstate. But obviously, instead of selling car insurance, we're selling financial insurance options, and that's where the book fits in. And here we come back to the overview of the book. I mean, we just wanted to give you a context of where the book will fit in your.
We've got a good question here, guys. What's wrong with adjusting iron condors as long as it's working and it's a working documented process? Well, there's nothing wrong with selling and adjusting iron condors, but being married to an approach. Well, no, not an approach, but being married to a specific trade is what I would say is the issue. Robots fail. All right, if you look at systems that want to, at 60 days I sell an iron, at 45 days every month, regardless of what's going on, I sell an iron condor, and then this is what I do and this is what I do, and you never take the time to evaluate what you're doing, and you don't take the time to understand what you're doing, and tweak what you're doing as things change, you are doomed long run, because a documented iron condor approach, if it's the same thing every month, will eventually fail. It will. And not fail like you're going to have to sell your house, but it may fail in that you give up an entire year once a month, or one or 2 months a year gives up an entire following, entire 10 months of work. Dennis,
that's correct.
At first
yeah.
You tried that, right?
Yeah, that's correct. At first I tried that, the McDonald's approach, where everything's the same. You start ABC. It works for a while if the environment is in your favor, but once the environment changes, things go against you. That's why we try to give you a framework where we address and we point out the key functions that you need to have in order to run this business. But it doesn't mean that the way you do each function is the same every time. Actually, let's go on to the overview of the book. And oops. Okay, here we go. Basically, this is the table of contents. I'll just go pretty quickly through it, and then we'll go through specific examples. There's 3 parts to the book. The first part is the framework, where we talk about how do we run the hedge fund as an insurance company. So we explain to you how the insurance business works, and then we go through each of the functions that we need to have in the business, which is trade selection, risk management, execution, trading plan, trading infrastructure, and the learning process. And I'll go through these a little bit more in detail once I show you the framework.
Mm-hmm.
And part 2 is implementing the business. We actually go through and show you what we call TOMIC 1.0, which is the one-man insurance company version 1.0. So it's a little example of how we would, of how we run the one-man insurance company. So we understand, we show a little bit about, in detail about volatility. We show you the 5 strategies that we use the most currently,
Mm-hmm.
and we go through an example of operating the business.
And that in of itself could be a book. I think that Chapter 9 is what 60 pages, 70 pages, something like that.
It's huge.
Yeah, 'cause I was writing it, and I wrote basically all of Chapter 9, and it was just a beast to write. And yeah, I think it ended up being somewhere along the lines of 20-some thousand words on its own.
I think we could have done Chapter 9 in 5 chapters.
Yeah, we could have. And understanding volatility, Chapter 8 just builds on it. It doesn't lay out. It's not the normal vol where they show you a log normal distribution, blah blah blah. It's more kind of application of volatility. And the framework section in of itself is also it's great. We give you kind of here's kind of the how to build it, here's how to use it, and then here's some things that we've I'll let Dennis kind of get into part 3.
Yeah.
But part 3 is here's some things we've learned along the way.
That's correct. So a little bit about the framework, and then we'll go into specific examples. Basically, we're taking the framework of an insurance company, a Geico, an Allstate. What are the key functions in the value chain of an insurance company?
Now, Dennis, here's a question. If you go with the Geico framework model, do you save 10% in 15 minutes? Just kind of wondering.
Well, if you go with the Geico model and you go to Amazon and buy a book, you save 35%.
Oh, that's nice. Yeah, you call it Scott Sheridan. I'm on the Geico model. Can you drop my rates 15%?
Yeah. Well, anyways, so the functions in the value chain are underwriting, which is identifying the risk that you're willing to take on. Remember, an insurance company takes on risk in exchange for premiums, right? So when you buy car insurance, Geico's you're transferring your risk of being in a collision to Geico, and they're taking on premiums. It's the same thing. So they have to identify in underwriting who are they willing to underwrite. Are they going to underwrite an 18-year-old with a sports car, or a soccer mom in a minivan? And then that's where pricing comes in, where obviously the rates for an 18-year-old is going to be higher because the claims are going to be higher. So that's the part of pricing. Reinsurance operations is, the insurance business, they don't take the entire risk. For example, if Geico had a big position of autos or of cars in San Francisco, right? And we know that if the big one hits, all the cars are going to be destroyed. They probably are not going to take the risk of the earthquake. They're probably going to reinsure with Lloyd's of London or some other reinsurance company against a big earthquake. They'll insure their cars, but if an earthquake happens, they're going to be passing that risk on to a big reinsurance company. Then you have claims processing, which is how they deal with claims, and customer acquisition is where, like Geico, for example, you're calling over the phone, but Allstate has agents out there in the community selling in their offices. So that's the different functions. And last, you have investment operations, is what you do with the float, all the reserves of premiums that they receive. What Berkshire Hathaway does. I mean, Warren Buffett takes the reserves and he invests it. Okay, so that's part of the value chain of an insurance company. So how does that relate to us as a one-man insurance company? Well, the part of underwriting and pricing is really trade selection. That's where we figure out what we're going to be selling or buying in the hedge fund, right? We select the markets. We select at what price we're willing to sell or buy. We select our strategy. We select our time frame in which we're going to operate. reinsurance and claims processing is really risk management. It's position sizing, it's figuring out how much risk you're willing to take, it's money management, trade adjustments, that's equivalent to claims processing. Portfolio insurance, that's the units which we might be talking about today. Units is like catastrophic insurance, the earthquake for Geico in San Francisco. That's buying insurance from a reinsurer. And portfolio diversification. Geico doesn't have all their vehicles in one state. I mean, it's actually throughout the U.S. and throughout different segments of drivers. It's not all 18-year-olds, right? And then the last part is customer acquisition. We don't have to actually go out and sell our options door to door. We actually just go to the option exchange and we sell it to the market. We don't have to have agents out there, but it's basically customer acquisition is the equivalent to trade execution for us. It's what exchange are you going to be selling it at? What strikes are the best strikes to be selling? Or is it better to sell complex orders or individual orders? All those are things that we answer throughout the book. And we really don't talk about investment operations because basically what we do with the cash that we get is put it in the money market or on treasury bills. So what is the basic framework of the one-man insurance company includes primary functions, which we spoke about, trade selection, risk management, and trade execution. But in addition to that, there are supporting functions that are necessary for our business, which is the trading plan. Every business has a business plan. We have a trading plan that we put in place so we have a guideline to follow. So we review it every single period. Maybe it's every quarter, every year, or every half a year. In addition, we have trading infrastructure. That is part of what Mark helped me at the beginning when we were starting to figure out which prime broker to use, what software we're going to be using for the hedge fund. How do we create all the redundancies, and who is well, in my case, who's going to be my auditor and the accountant and all that and so forth. And the last one, which is very important, is the learning process. It's that feedback loop. Especially what we said originally is that nothing is static. Everything keeps changing. The market keeps evolving. You need to have a process for learning in place in your business so you never stay stale and you can always upgrade your skills and upgrade upgrade what you're doing, right? And that's basically what we go through in the book. Oops, sorry. So now I'll let Mark talk a little bit some examples. Are we going to go
well, I just want to. Yeah, I want to hit. Yeah, I'm going to show a couple of. I'm going to hit a couple of kind of little highlights that we hit in the book. But what I wanted to do quickly first was, I think this slide in of itself is a super important slide because it really lays out what makes a successful trader. You can, from here to here to here, this is the complete package. I don't see it laid out this way a lot of times, and by many instructors. And when I saw this the way Dennis had prepared it, I was like, oh, this is really good. And market selection and strategy selection and time frame are really important. Trade selection is, just like an insurance company, ensuring the right people at the right price. In our example, Dennis talked about the 18-year-old mother of two versus, or the 18-year-old mother of two, the 45-year-old mother of two. Let's hope not.
Right.
The 45-year-old mother of two versus the 18-year-old sports car. Well, that's really what trade selection is about. It's okay. Geico insures tons of terrible young drivers. So does State Farm. So does everybody. In fact, they're required to take a certain amount of terrible drivers.
Yep.
But they charge them the right price. And that's really what trade selection is understanding what your risk is on the trade and figure out the right price for that trade. And this is where, looping back to our friend that was asking about what's wrong with adjusting iron condors as long as it's a working process. Nothing if you're evaluating the risk that you're receiving on your iron condors. If you're selling an iron condor at the right insurance price, hey, that's a great trade. Dennis, that's a chunk of what you do, isn't it?
That's correct.
Yeah.
I evaluate if the price is correct, if I have an edge, or basically they're paying me more than what I think the insurance is worth, I sell it.
Right. And shockingly, I know this is going to sound crazy, but if the insurance is way, way, way too cheap, what do?
I buy it.
Yep. It's okay to buy options, folks. Although the book primarily does focus on the selling of options. But, all right, so this was a good question I thought kind of fit now. And I'll throw this to you, Dennis. Dennis, do you think it's important for a novice to focus on one market segment, i.e. just gold, futures, Forex, etc., or should we look at the whole basket of things?
I would think, no, not one market segment, one type of product. I would say if, you could trade options in general, but not just gold options. So if you did maybe a couple of products in a couple of options, a couple of underlying. So have a diversified portfolio. Choose five underlyings that you might follow. Maybe SPX, I don't know, Exxon, or
IBM,
Apple.
Apple.
And then don't have just one specific product. I know some people that just do SPX. I mean, I probably was one of those at one point in my life. And it's not, you're not really diversifying just having SPX. You might think that, oh, it's the S&P 500 or it's 500. No, it's not. You're trading the option. You're trading the market only. So it's not that you're diversified. Volatility could be high or low, and it could be going in favor or against you. You might not have an edge in the trade that you're trying to do.
Yeah,
right?
and there are times where equities, SPX vol gets way out of line relative to individual equities sometimes. It's incredible because it's such a hedging product. So you have to be aware of kind of what's going on. Yeah, Dennis, I think that's actually the perfect answer is, one, when you're just learning, don't bother trading for a while is the first thing I would say.
Right.
And this is something we really stress at Option Pit is you have to know what you are trading backwards and forwards. Now, I don't mean the product. I mean the instrument. I don't know every single optionable product on the planet, but I know options like the back of my hand. So basically, with little to no study, I could walk into just about any option pit in the world. As long as I understood the underlying product, I could make markets in it. And that's because I know options so well. And that applies to futures, that applies to Forex. So be aware of what drives things and how the product works, especially with options. So, yeah, with that, let's move on to, I'll get through your boy, Dennis, your graphicking is pretty top-notch. All right, so here's a couple of highlights. This is from kind of the trade selection section, and it's from the chapter, the understanding volatility, how important it is. And one of the major thematic things we discuss is that volatility is three-dimensional. All right? Professional traders should know how to evaluate not only market conditions, but volatility conditions. You'd be surprised how many traders spend a lot of time thinking, is the market going to go up or down? And they don't think about whether volatility is too high or too low. All right?
Well, actually, volatility is the third dimension.
Yeah.
Right.
Yeah. So it's especially in options. Yeah, it is the third dimension.
Correct.
So understanding vol condition leads to better option trading. It's like understanding the fundamentals of a stock leads to better stock trading. You know, if you really know a stock up and down, you're going to be in much better shape. Someone said implied volatility. You know, implied volatility of options, but here's a little quiz. What are the 5 factors that go into an options pricing model? First person to know this, you know, first person to know this, I'll send a copy of the book, a personally autographed copy of the book too.
They're Googling it right now.
Yeah, no. Here we go. All right, here we go. And this is actually a great one because I'm guessing we're not going to get. So we're seeing a lot of people say, underline. Here's what we're getting from everybody, and I'm going to tell you, everybody is wrong. All right. Yeah, this is pretty close.
Yeah.
I'd need some clarification. So, the one Sam, or you know, this trader had underlying timed expiration, strike price, interest rates, and implied volatility. All right.
Mm-hmm.
So, all right, no, all right.
Yep.
Competition's over. Nobody got it right. And I knew that was going to happen. I had a pretty solid feeling I was going to have that. You know, the underlying is absolutely correct, and timed expiration is correct. Strike price is correct, and interest rates or cost of carry is right. Implied volatility is not correct. All right, the pricing model, Black-Scholes rigged market. That's funny. Black-Scholes, Cox-Ross-Rubinstein, trinomial, Sabre, any of those models. The volatility the model is supposed to be using is forward volatility.
It's your
Believe
estimate.
it or not. Yeah, forward volatility, which is, if you know what forward volatility is, call me up, and we will go. And we'll go and figure it out. No. So, well, that's an important thing. Is that, and that is what gives you a fundamental understanding of where the model is flawed. In that, the model implied volatility is an output of knowing the answer and knowing 4 of the inputs.
Yeah, you're solving for volatility.
Yeah, you're solving for volatility. How important is it for traders to really know stock technical analysis? Not very. You know, I would say technical analysis is important to understand at a visceral level because other people are looking at it. Trader, you know, the model wants to use forward volatility. It ends up using implied volatility. So when I'm talking about implied volatility, when I'm talking about vol on our sheet here, all right,
It's implied volatility.
I am talking about implied volatility. But I want you to be aware that the model, and this is why understanding implied volatility is so important, the pricing model that you're playing with, that is spitting out the Greeks that you're using to evaluate risk, is not using the right volatility. It's using extrapolated volatility pulled from a price. This is how, and I'm sure everybody's seen this, you buy calls on IBM. All right, IBM's up $2 the next day, but volatility's in, and your delta hasn't gone up, and you didn't make any money. You know, that is what we're looking at. So, getting back to before I go too off, understand the vol conditions leads to better option trading. All right, it just is. So, what are the vol conditions you need to understand? So we kind of talk about the steps to evaluating volatility. So it's 1, understand the cause of the volatility in your instrument. All right. 2, what is the at-the-money implied volatility? So that's 1 point along the curve. All right. I may be jumping the gun a little here, but will you have a special webinar price for attendees of this webinar? I ask because I've got to leave and may not finish the webinar and would be interested in any special deals you have for attendees. Yes, we're going to offer from Option Pit, which is my education business. At the end, I'm going to offer everybody a deal where you get 10% off any product that I offer, and I'm going to send you a autographed copy of our book signed by me and Dennis. So if you sign up for any one of our products, so I will buy you a book and you'll get 10% off. The code that you're going to use is code Chris Smith. Think you guys can remember that one? And that's any product. All right, so steps to evaluating volatility. So what is at-the-money implied volatility? All right, and that's an important one. Then what is the curvature of skew? The volatility smile or skew is I cannot understate how important that is to active traders and to traders. Yeah, sorry.
This is huge for like the person that was trading iron condors and butterflies and even calendars. I mean, understanding this is so important to know what to use at the right time.
Yeah. So, what is current term structure? And so that's the relationship between the contract months. So how does May relate to June, to July, to August? And then finally, how expensive are units? And I don't mean Randy Johnson. All right. And so now let's do a little sample evaluation. All right, so here is SPX. So cause of volatility in instrument. And then I wrote this up a couple days ago, obviously, and it's, U.S. economic fears, Eurozone, and Apple earnings. Anybody? Here's a little quiz, and I will send you a copy if first person that gets this right. Apple makes up 20% of the NASDAQ 100. The VXN is the VIX of the NASDAQ 100. Apple volatility, the VIX of Apple, was in 8 points. What percent, how much did Apple directly affect the volatility of the VXN, the price of the VXN? If you get that right, I will absolutely send you a book. $1.6. Yeah, no, the 1.6 is right. All right, we got a winner. This person that I wrote yes to, email me shoot me an email, and I'll get you hooked up for your autographed copy. It'll have to come in. It'll be coming in kind of mid-June because that's the next time Dennis and I are going to see each other face to face, I believe. Mm-hmm. All right. So, what is at-the-money implied volatility? It's at the long-term mean and appears to be falling. Current trend of volatility is important. All right. Be aware of what's high and what's low. I remember listening to somebody describe, and this is in 2009, they're describing volatility of 30 is low, and actually if you watch the way that volatility was coming in, you could tell that 30 volatility was actually high. And so the problem was the person was looking at what was at the end of 2008, not what was going on forward at 2009. Kind of an interesting thing to be aware of. What is my email address? Email me any questions.
Mark@optionpit.com.
Yeah, here. I got it in the chat as well. So now, what is the, we talked about what is the curvature of skew? Are puts expensive? Are calls cheap? Or vice versa? All right? And we talk about the fact that there are some direct absolute correlations between curvature of skew and a couple of spreads and whether they're successful or not. It's like clockwork. All right. What is current term structure? IV and near terms are trading at a steep discount to back months options. All right. And how expensive are units? With VIX low, far out of the money puts that are $2 or less are not very far in strikes terms. All right, so possible trades. Here would be, based on this evaluation, here would be some trades that would make sense. Butterflies, ratio back spreads, and time spreads. That would be where you'd now start looking for trades. You know, you just ran a screen yourself and pulled up trades that would make sense. That is how professionals think, guys. That is how a TOMIC trader thinks. All right, now here's a highlight on execution. And I spend a nice period of time blasting what they like to call the smart router. What your broker says. Our proprietary smart router sends your order to the exchange with the best bid or offer to ensure the absolute best price on the trade. Now, I want you to know that no broker actually says this. I wrote this up myself and made it up because I didn't want to call out any broker. All right. Now, what they should say, our proprietary smart router sends your order where we will get the highest payment for order flow possible, even if it is not in our trader's best interest. And that is absolutely the truth. All right? So, you know, the exchanges matter. The SIBO, the PHLX, the ICE, and the Amex are traditional exchanges. All right? Now, and the PHLX and Amex actually have some idiosyncrasies of their own. What a traditional exchange means is that the market makers pay a payment for order flow if you hit a bid or lift an offer. All right, so if I'm quoting Apple, 600 calls, 1718, and the 610 calls, 1718, and you pay $18, I would pay a fee to the provider. Well, I'm going to show you how it happens.
No, and Mark goes through this in detail in the book of payment for order flow.
All of the screening material for trade selections in the book. Yes. Mm-hmm. All right. Yeah, I mean, it's not just TOSS. All right. I don't want you to think TOSS is actually, of these systems, is one of the better ones because they allow you to override their smart router without a charge. So then you've got the NYSE, BATS, NASDAQ, BOX, and C2 that are what we call that we have maker-taker exchanges. Basically, if you rest a bid or an offer, you will, you get paid on that. So now, let's pull up a little order. All right. So this is the SPY at the end of the day. All right. And you can see that the market was 244, 251. This is in August because I wanted a wider market. Oh, did not mean to do that. All right. Now let me just kind of quickly point out how these things work. All right. Can everyone see my mouse?
I think it got stuck.
No.
Okay.
Can you see my mouse?
Yeah. Now.
All right. So the way a traditional exchange works on the SIBO, for instance, if you hit their 244 bid, they would pay the broker. If you lift the 251 offer, they'd pay the broker. Anything in the middle, the market makers don't pay. All right? But it's important to be aware that this is where all the liquidity is on the SIBO, the ICE, the PHLX, and the Amex. You can probably tell by the size of the offers. All right, so if you're working a mid-market offer, if you're putting in, well, kind of, they are. I'm not. If you're putting in a mid-tier offer, all right, you would want it on an exchange where the market makers don't have to pay to lift your offer or hit your bid, and there's the most liquidity, right? That would make sense, right? Where in the most liquid markets will have the best fills. That's typically true. Anybody disagree with that? All right. So now here's what I did, and I want you to know, I trade on about 5 different platforms, and I spend a lot of time watching, well, actively on 3. I've got 2 that are in paper that I'm aware of how to use. And I put this order in live. All right, so this order, I'm going to put in a bid to buy one August 144 call for $2.46. Where, of these exchanges, where would you want your order to go? If you could pick one, if you had to guess, where would be the theoretically, where is the best market to send your order? Theoretically.
I don't see answers.
Yeah, we do. Here we go. This is correct.
There you go.
Yeah, correct.
Mm-hmm.
Anywhere where the bid is highest. No, you don't really care about the bid. You care about the offer. So the PhilX has by far the biggest offer, then Amex, SIBO, and ICE.
Mm-hmm.
All right? And that kind of answers your question. You want it to go where there's the most liquidity. All right? You certainly don't want it to go where there's the least liquidity. All right? So I put this in.
So where did it go?
Well, let's take a look. It went right to the NYSE where there's the maker-taker fees and had one of the smallest offers.
Oh, Miracle didn't go to the NASDAQ.
You know what? It was after the bell, and I don't think the NASDAQ can handle after the bell SPY orders. I think that was the only reason.
So otherwise they would have sent it to the NASDAQ.
Yeah, well, the NYSE pays too.
Oh, okay.
The NYSE pays, NASDAQ, usually it goes to NASDAQ or BATS, which is Z. You watch your equity orders, guys. If you're working non-marketable equity orders and you use any market, I mean, and I pulled out TOS because they have the best way to show me, for me to show this. But all of the different guys do this. All right, everybody. So yeah, I mean, you can legitimately see how our order moved. So, you know, as you can see, if that was the as I was to say, if that was the smartest place to send the order, I'm the king of France. Smart routers send the order where they get paid the best, you know, where it's smart for them. This is why the right platform matters, and routing is easily as important as commissions. I mean it. By managing your own routing and I don't just mean TOS. There are other places that are good. I actually like interactive brokers better than TOS. In terms of speed, different things like that. TOS has gotten worse and worse. But in terms of being able to route and manage your orders, that should be very important to you. All right? And now let's kind of look at units. All right? And Dennis, I think, you know, I'll let you anecdotally tell a story about August. But an inexpensive option that has Greeks that do not fall within the model. All right? So one thing you have to understand about the pricing model is that it starts to kind of stop working at the periphery. I used to joke that the model is a lot like Jay Cutler. It's great between the 20s. So from 20 delta to 20 delta, put to call, the model works pretty well. But once you get beyond that, it stops working.
It's like Newtonian physics, right? It works within the certain boundaries, but it's not
yeah,
generalized.
that's why it's called a model and not fact. But you know, these cheapy puts can absolutely save your life. And you know, I was going to show an example, but You know, I had an OEX trade from the flash crash, but you know, while I'm getting this ready, Dennis, you can probably tell a good story about what happened in August even.
August of last year, right? Was it August?
Mm-hmm.
Yeah, luckily I always have units around, or most of the times actually. I always protect the hedge fund against a huge crash. So like, for example, if the market crashed tomorrow 25%, my portfolio will actually be up because I buy units units are out of the money puts. In this case, most of the times I'm using SPX puts. And in August of last year, remember that the market had a big tumble. I don't remember exactly the date, but for 2 or 3 days, August 9th, it was 2 or 3 days.
August 8th and 9th.
8th and 9th, it went down really, really, severely. And my units, which I had, probably cost me, I don't know, maybe $1,000, and they were worth about 200,000. That was a hedge for a portfolio, so they were worth it for me, and it helped the portfolio not to lose during that time. And of course, you have to know when to take them off, right?
Right. That is a very important key. You do have to know when to take them off.
Mm-hmm. But I mean, units. My portfolio almost always has units on.
This is not gonna. Is this not gonna give me data here?
I shot down my screen already. Otherwise, I would show you.
All right, I think we got a winner here. I think we got a winner.
Okay.
We do. All right, so I'm just gonna show you real briefly. This is Thursday, April kind of 2nd, and I'm gonna show you what can happen to a cheap put. This is the OEX. I had a big trade on that made a bananas amount of money because we were long a bunch of these. So let's just say on something like the OEX, I typically consider a unit anything that's less than like $1.25. But let's just see. Let's pull up a vol chart.
But Mark, most people are probably wondering if you're buying puts so far out of the money, and the market doesn't even get to reach that strike price. How does it protect you?
Well, one of the things that happens is that when the market blows up, major funds and different things like that will come in and try and buy a bunch of at-the-money puts, all sorts of different things like that. And the way market makers protect themselves, and actually a lot of people protect themselves, is they race to buy these cheap puts. And so the combination of the snowballing of Delta and Vega and vol running up, they just absolutely explode. If I was going to draw the curve, and this is something that's in the book.
Yeah, what happens is that the demand for those cheap puts goes up exponentially, and then so the value, or they bid them up all the way up. So you're not only getting the protection of the delta falling, you're getting the explosion in vol. So that's why the units explode exponentially versus linearly.
So this is kind of, imagine the red line is our starting curve. This is kind of what happens when volatility goes up. All right, notice how, the further down you go, the more it moves. And we'll see that. We're going to see that right now. Let's mark down, so you can see vol's pretty low. Let's go to what day is this? This is the 21st. So we'll go to, let's go to the 21st, which is, well, today's fine. So here we are, we're 60 bucks out of the money, so 10% out of the money, and we're going to buy 10 80-cent puts. 800 bucks. All right, we don't even need to do the trade. I think we're running a little short on time anyway. Mm-hmm. But what I want to do is then point you toward kind of what happens in May. I believe the flash crash is May 6th. All right.
You probably won't be
Protective
able to
puts.
see it.
They're not exactly the same as protective puts. I call them portfolio insurance. It's the same thing. Call them life insurance.
Mm-hmm.
All right. You know, life insurance is something you never really want to use, right?
It's like the earthquake insurance for Geico, for the cars in San Francisco.
Mm-hmm. You know, so I believe the
It was like at, yeah,
one,
well, you have
1
to get
o'clock.
the time, yeah.
So I want everybody to pay attention to this gain and loss. No, we're not quite there. It might be this. We had a huge downdraft. Now, notice on a 10 lot that I spent 80 cents on how much money I'm up right now.
Mm-hmm. Yep. You're up like 700%.
Mm-hmm.
600%. You're up $3 and a 50.
Now I'm up 1,000%. You see that? We're up basically 1,000% on $800.
Yeah, it's insurance. The comment that says it's just like insurance. It's something you pay for with no return. Well, but it's portfolio insurance. It's like I'm making money on most of my other trades, and the units are to protect against, you know, unexpected catastrophes. I mean, if the market fell 25%, I mean, I would think that's a big catastrophe, right? So if that protects the fund, where if the market fell tomorrow 25% and I don't lose anything, that keeps me in business.
Yeah, I think we're down even, yeah, I mean, the market just gets destroyed. And yeah, I mean, lots of guys had these things on, and it saved a lot of people's butts. I simply consider it a cost of running business. Yes. Now, in later versions of TOMIC that are not specifically in the book, Dennis and I have definitely gotten better at doing it in more cost-effective ways, let's say.
That's correct.
But yeah, it's the basic concept. You know, we're not here to tell you exactly what Dennis does. I don't think you want to do exactly what Dennis does because you're not Dennis Chen. All right. But do you need to be concerned when you close them? No. No, you close them when write them off your portfolio unless the market really breaks. All right. So, you know, kind of wanted to show you how those can move. You know, and from that, you know, let's take some more questions now. And I'll post. You know, one of the fun things that Dennis and I noticed yesterday, we reached #1 on Amazon bestsellers for options books. Kind of a cool thing. We're a full 23 cents cheaper than my good friend Shelley Natenberg's book. Take that, Shelley. You beat Shelley. Can we follow Dennis on the website, Twitter, etc.? I mean, Dennis is, you know, he basically is a hedge fund trader. He's active at Option Pit. I do have him do some stuff there. He writes blogs for us every now and then. Are you on Twitter at all, Dennis?
Yes, I am, but I don't have it open to the public.
Yep. See.
you
So
can find me on Option Pit.
Yeah,
Option Pit. I'm active there.
Yeah, optionpit.com. And you know, to be honest, if you, yeah, I mean, that's exactly right. So he'll write a blog for me every once in a while. Is the concept to buy out of the money puts every month? Yeah. Is the book already shipping? It ships end of May.
Yeah,
How
if you
long?
pre-order it today, you should be getting it the first week of June.
Well, I guess I just looped back to learning on your diagram. Neat stuff. See, that's awesome. That makes me super happy. You know, and I don't want you to think that I'm not learning. I had Dennis, you caught that. We had a student come in last Tuesday, and I thought that I understood the VXX like really well, and the way he described it, I had something wrong in there, and it's completely changed my approach to trading the product. I mean, it was fascinating, wasn't it?
Yeah, we
And
were trading based on a certain assumption, in which we found out it was wrong, right?
yeah, and now it turned, and I'm learning about products. One of the things that makes, I think, Option Pit different is how dynamic it is, and not in we've got a different student teaching a different way of trading an iron condor, but in we've got a student that's trading Australia versus U.S. We've got students that are trading VIX versus VXX. All the different types of. Have you tried trading 3-time ETFs on TNA and TZA? Those are very interesting ones to trade. There's some really cool kind of backspread ideas that you can do there. I have messed around with TZA a little bit, but that is dangerous stuff. That's the triple long and the triple short of the Russell, I believe. And yeah, those are some crazy ones. So yeah, I mean, the levered stuff. You know, there are a lot of people that are afraid to look at VIX and levered stuff. I think if people are telling you not to trade it or that you don't need to know it, then that's absolutely the type of stuff you should be trading. I know it sounds counterintuitive, but if somebody tells you you don't want to trade that because it's difficult, that is exactly why you want to trade it. Are you just buying the protective puts to protect the downside on iron condors that you're trading? Iron condors, butterflies, time spreads, straddles, strangles,
Well,
you name it.
yeah, I actually don't look at it that way. I look at it as the entire portfolio. When I look at my risk, I'm looking at a risk level of the portfolio, an entire portfolio. So now when I do condors, I don't worry about putting the protective put because I'm looking. I would do the protective put for the entire portfolio. But if you're beginning and you're just doing it from a position standpoint, yeah, you should be looking at protecting each individual positions.
Is this book pitched at beginner, seasoned option trader, and all those in between? It is not beginner. Not pitched for beginner. When you get through like a Natenberg, it'll be a great trade.
We give you a list of recommended books to start with before coming to this book.
Yeah. How do you calculate how many units you buy for a portfolio? Loss basis. You know, if the market moves this much, how much loss are you willing to take? If you're not, and if it's beyond that level, you need to buy more protection.
Yeah, like on my screen, I know exactly how much loss I would take if the market falls 3, 6, 9, and 15%. So at each level, I know exactly, or more or less, how much the entire portfolio will lose, and then I would adjust my units depending on how much I need to protect.
You said the model is wrong. How do you calculate? You know, the model is wrong, so you have to. You don't calculate anything. It's understanding intuitively where the model falls apart and knowing how to manipulate that. It's you know, think about it this way: if you understand options well enough, it's similar to kind of drifting or different functions of racing. You know, you get an idea of how wind resistance is going to affect things, all sorts of different things like that. Do you show how to allocate your funds if you're bullish, bearish, neutral? Not as much. Not as much. It's more of just kind of how to build a whole framework for what you're trying to do.
It's how to build a business, and
Yeah.
then we give you each section of the business, and we tell you how to fill it in, but we don't tell you. Well, we tell you what you need to fill it in with, and we give you an example, but you have to actually tweak your own. You have to get your own aha moment. You have to. By looking at what we're doing, you'll eventually get to that aha moment, and you'll have your own framework.
But no, somebody said, what do you primarily cover in the book? Credit spreads, condors. Yeah, out of the money call and put spreads. By the way, there's no such thing as a credit spread. Condors. How long? Calendars, butterflies, back spreads. Ratio spreads. You know what? Yes, but even better, go like me on Facebook, like Option Pit on Facebook, and we'll send you a great ebook for free that basically walks through that. It's all about synthetics. How long does it take to become a successful option trader? 1, how smart are you? 2, how dedicated are you? 3, what kind of gut do you have? Then I'll answer that question. So the answer is, it depends.
Mm-hmm.
And, and for some people, in fact, a lot of people, the answer is never. Do you compare option view versus power op? No. No, we do not.
No.
Option view was given to us for free to use, and so we used it in our book. The truth is, I don't think any of those back testers are that great anyway. Have you found one that's just unbelievably great? Credit spreads are options that bring in a net credit to your account, right? Okay, I'm going to have a little fun here. All right. All right.
Now you got him going. I think
yeah, I know.
I don't think we don't have. I don't know how much time we have left here.
Chris said we could take as much time as we wanted.
But
I'm about ready to go, but I'll tell you, I'm going to finish this up and go pour myself a cocktail. I'll tell you that much.
When the minutes run out, does it automatically shut it off?
No, I don't think so.
Okay.
All right, so let's look at. We're going to look at 2 spreads, folks. All right, so let's look at. We've got the diamonds trading 130. So now let's look at the 127, 125 put credit spread, right? Everybody agrees credit spread, correct?
You know what? The red thing says it's stopped.
Oh,
No.
Did it stop recording?
I don't know. It looks like.
I'm sure.
No, it's still going. It's just when I set up the presentation, you have to tell it how long the presentation is going to be, and it gives you a timer. But
you should always make the timer longer for me, Chris.
it's just a suggestion.
Right. All right. So here is our put credit spread. Correct. It's the 125, 127 diamond put credit spread. Now I'm going to briefly stop showing my screen.
I can still see the screen.
Oh, I thought I stopped showing. Well, I paused it. That's all right. All right. So now, all right. Now I'm going to show my screen again. Now, I made a change. Who knows what change I made? Is this a credit spread, everybody? You've changed the implied vol, right? Oh, someone says short call spread right up on top. Yeah, I changed it to a call debit spread, right? I clearly paid for it, right? I sold 370 and I paid 535. I paid for that spread, did I not? That is a debit spread. But wait, how is it a debit spread if it looks exactly the same as a credit spread? It's called synthetics, folks. You should understand those clearly. Super important. Yeah, again, you can email me, mark@optionpit.com. I'll make sure Anna sends you a copy of the ebook. What barometer do you use to determine when you become a successful option trader? Time being successful or profit? Oh, I would say dollar bills, wouldn't you?
Yeah, it's are you consistently making money?
Yep.
The key there is consistently.
Mm-hmm. Yeah, so I would concur. Can you keep going on synthetics? We could be there for hours, but it's basically call minus put equals stock minus strike plus interest minus dividends. That is the duct tape that holds the entire option world together. Yes. All right. Any other questions, folks? Does the book show how to combine condors, calendars, and mamad and manage overall portfolio by the Greeks? You know, we don't. Not as much. You know, one of the things that we say is you should be aware of kind of your portfolio risk, but you should really manage each position separately. And then just run risk across the whole portfolio. So we kind of talk about it, but I don't think we got into the entire process.
That's the next book.
Yeah, that's probably the next bit. Do you incorporate Vega analysis? Yes, we do talk about weighted Vega.
Mm-hmm. Yeah, there's a chapter that's lessons on volatility.
Yeah, so there's a lot to learn. It's a really great book to get you up just to the point where you're ready to kind of build your business. If you trade commodities, what is a good protection for in a unit? Well, an upside call probably, and actually a downside put. It's kind of interesting. Mm-hmm. Commodities can explode up and explode down in ways that equities can't. Where's the best place to buy your book? Amazon, OptionPit, website, other. You know what? Chris had us on as a guest. Use Chris's link. Let's pay him for his time. What about gamma positions? I do talk about some scalping of gamma.
Yep. Yeah, you have two sections on gamma scalping.
Yeah, and gamma scalping is meant to defend a position, not to really. You don't gamma scalp to actually make money. You gamma scalp because you got long something at the right price, and you're defending the position.
How do you divide risk across trades?
Oh, I think you need to have kind of be aware of what your total portfolio risk is. You shouldn't have, beta weighting to the SPX and having an overall what your portfolio delta, gamma, and Vega, weighted Vega is very important. Yeah, Dennis, I think our next follow-up book would be a good kind of portfolio thing. Did not hear about adjustment strategies. Those are in the most used strategies. I will talk about on each strategy I go through. I start with here's why you want to do the trade. Here's how to do the trade. Here's how to manage the trade. Although I will say this over and over and over again, there's way too much emphasis put on the retail world about adjustments and not nearly enough put in about putting on a good freaking trade. All right? If you put on a good trade, you will adjust a lot less. All right? So that is one thing I will say over and over again.
Yeah, a lot of your questions are answered.
Do I sell naked?
Sell naked.
Well, no, I'm currently clothed. The book doesn't get into that. But as a prop trader and kind of market maker, obviously that's a part of my business, yes.
Mm-hmm.
Yeah, it's fun, one of the fun things. I'm actually, at Option Pit, I've got some really advanced guys that I'm teaching how to trade literally delta neutral and vol trade. It's really fun. But we definitely have a lot of guys that we're teaching them how to trade iron condors well, how to trade butterflies well. I've got a guy that he and I were talking on Monday. He has a full-time job, can only trade. He's like, Mark, how do I incorporate? You tell me all this evaluation stuff. How do I incorporate that? I'm a full-time worker. I'm like, real simple. When you get home, evaluate the market, and if things look good, do a trade, and if not, just don't. It's great. So, yeah, and if you have any questions, you can call me. Let me give you my cell phone number. It is 630-862-1152. Please don't call me in the middle of the night. But yeah, this is a fun one. 630. I'm in Chicago. That's another rule. If they're not in New York, Chicago, Philadelphia, or San Francisco, probably not worth listening to. For delta neutral trading, how much are Greeks covered in the book as adjustment techniques? It's kind of a hard question to answer, but not as much. I actually think that if you're managing an individual trade that you've set up, I found that unless you're actually delta trading vol and you're versus trading a spread, this managed by the Greeks thing is very clicky but not really that useful. Would you say, Dennis?
Yeah, that's correct.
Yeah.
I mean, unless you're looking at the entire portfolio, it's not as important. I mean, when you're doing individual trades.
There is my phone number, all. I'm coming to Chicago for a coffee event in June. Is there a way? Yes, probably. Again, contact me. Can we text you? Make sure you say who you are. What type of calls we accept? As long as, no sexy calls.
No.
That would be a little inappropriate. I'm happy to dole out relatively simple advice, but if you're asking me to fix your whole position, I have people that pay me for that type of stuff. So if you're in a real bind, I'm always the type of guy that's going to help you. I am, but not here to basically hand out a bunch of free advice. I know it sounds terrible, but lawyers don't like doing it. Neither do educators and option consultants. Yeah. So, hey, you know what? Hopefully you people have better things to do than to harass a 33-year-old father of one. I don't know where the second one is.
Where did the second one
At least
come
I
from?
hope there's only one.
I'm just wondering whose number did you really hand out?
Yeah. No, it's great. Anyway,
Well-
yeah, happy to give everyone my cell phone number. If you need anything, seriously, give me a call. I have no problem talking to people. I'm here to help.
Well, guys, I think it's probably time
Well,
that
this is fun.
we wrap this one up. Unless there's a last-minute question that gets thrown up there. In the chat window, you've got Mark's cell phone number, and right above that you have the link that will take you over to Amazon so you can pre-order the book and drive the discount even further. And with that, I think I did hit the record button, so we should have a recording. It'll get posted. I'll send an email out to everybody, and I'll include not just only the link, but I'll to the video. I'll make sure you have the link to the book and anything else you might need.
Yep.
Well, thank you very much, Chris. This has been fun.
Yeah, thanks, Chris. It's been a lot of fun.
Yeah, and once the book's out, we'll maybe give it 30 days or so everyone can give it a good read, and then we'll have you guys come back.
That'd be awesome.
Excellent.
All right.
All right.
Have a good one.
You guys take care.
Yeah.
Thanks for joining us, and we'll be in touch.
All right, thanks,
Great.
Chris. Have a good one.
Thank you. Good
Bye.
night. Bye.
The organizer has ended the session, and this